Welcome to Deloitte Financial Reporting Updates, our webcast series for issues and developments related to the various accounting frameworks. Today's presentation is Bringing Clarity to an IFRS World, IFRS Quarterly Technical Update. I'm John Quigman, your host for today's webcast, and I'm joined by others from our national office. Before we get to our agenda and our speakers, a few housekeeping items. In the lower right-hand corner of your screen, you'll see the webcast links, including a link to download and print today's slides, and links for webcast assistance and Deloitte Updates, upcoming sessions, and archive sessions. If you have a pop-up blocker on your computer, you'll need to disengage it in order to download the slides and participate in our polling questions. If you know of colleagues who couldn't attend today's live event, they can simply register at any time the same way as you did, and they'll be able to view the archive webcast within 48 hours. So feel free to invite your colleagues to take advantage of this feature. Although you're on listen-only mode, you can ask our presenters content-related questions at any time by entering your question in the box at the bottom of the screen and clicking Submit. We'll do our best to respond to your questions and comments during the presentation. We also have interactive polling questions that will appear on your screen throughout the webcast. We invite your participation by simply answering these questions. A summary of the results will be provided on screen shortly afterwards. Okay, now let's get to our agenda and our speakers. First, you'll hear from Anne Lamb, who will discuss new amendments, provide an IFRS Interpretations Committee update, and discuss some evolving practices related to IAS 19 on employee benefits and the classification of liability as exposure draft. After Anne, Maryse Vondet will discuss upcoming changes related to IAS 16 on property, plant, and equipment and IAS 38 on intangible assets, as well as IFRS 15, revenue from contracts with customers. After Maryse, Kerry Daniluk will discuss IFRS 9 financial instruments and provide an IFRS discussion group update and insight into future accounting amendments. We'll conclude with a brief Q&A session. You can read bios of our presenters and access the agenda and technical support in the navigation area on your screen. Please keep in mind that we have a lot of material for a 90-minute webcast, so we'll need to keep the discussion at a fairly high level. I'll try to ask our speakers questions throughout the webcast. I'd like to remind our viewers that our comments on this webcast represent our own personal views and don't constitute official interpretive accounting guidance from Deloitte. Before taking any action on any of these issues, it's always a good idea to check with a qualified advisor. Okay, let's kick things off with our first polling question. We're going to ask everyone online to participate with our polling questions. Remember that you have to disable your pop-up blocker if you want to participate in the polling questions. For each polling question, select the best answer for your circumstances, then press Submit Answer. Okay, I hope you like trivia because our first question is a trivia question. How many amendments to standards are effective this year? And the answers are, I didn't know there were any, 5, 11, or 15. Click on your answer, then remember to push Submit Answer to register it. While we wait for the results of the polling question, I'd like to remind you that today's webcast may be counted towards your continuing professional education. If you stay with us for the whole webcast, you can credit yourself with 1.5 hours towards your yearly total. This applies to those in public practice and those working in industry. We don't issue certificates for the webcast, but your email registration confirmation can form part of your documentation in support of your attendance. Okay, let's have a look at the responses. Okay, 62% say 5, 22% say 11, and just over 13% say they didn't know there were any. Well, I'll tell you what we're going to do. We're not going to provide you with the correct answer, well, at least not yet. We're going to keep you in suspense for a few minutes because I think Anne's presentation might provide some clues. And with that, I'll welcome Anne Lamb to our webcast. Anne is a senior manager in the IFRS Center of Excellence in Toronto and has over 14 years' experience in public practice. Anne's main area of focus is in the determination of final technical positions on IFRS interpretation and application matters for other IFRS centers around the world and client service teams in Canada. Over to you, Anne.
Thanks, John. So great polling question to start off with. So for those 22% of you that answered that there were 11 amendments that are effective this year are correct. So this actually may sound like a lot, but 10 of those 11 amendments are actually coming out of the ISB's annual improvement process, where they make minor changes, are made to existing standards, and really the changes are made to clarify the guidance or to correct for any minor errors or conflicts. So let's start. So this table lists out the amendments that were effective for annual periods on or after July 1st, 2014. So for calendar year-end companies, these changes are effective for Q1, other than the IFRS 2 and the IFRS 3 amendments, which were effective earlier. And I will talk about these a little bit later. So on the first row, you will see that there were some minor amendments to IAS 19. So for those of you that have defined benefit plans and have contributions from employees or third parties that are linked to service, this amendment may impact you. So in general, what IAS 19 says is that you have to consider contributions from employees or third parties when accounting for defined benefit plans. So for example, if those contributions from the employees depends on the number of years of service from those employees, then what you have to do is you have to attribute those contributions to those years of service using the same method as you would normally use for the calculation of the gross benefit. So at the end of the day, the changes really just clarify the accounting for these types of contributions. The next 6 amendments are minor changes made as part of the annual improvement process in the 2010 to 2012 cycle, and I won't speak about all of them in detail, but I'll just highlight a few. So the first one is on IFRS 2, and so this change is effective for grant dates on or after July 1st, 2014. So if you granted stock options after this date, the amendments may impact you. So what are really the changes? What it comes down to is adding some new definitions for performance and service conditions, and also changing the existing definition of vesting and market conditions. So the impact could actually potentially be high in the actual fair value calculation, so share options, if your entity issues conditional awards. The IFRS 3 amendment is also effective for transactions on or after July 1st, 2014. So if you had an acquisition after this date and you issue contingent consideration, you may be impacted. And as a quick reminder, contingent consideration is essentially, it's an additional payment that the buyer has to pay to the seller if specific conditions are met. And what these amendments make now very clear is that contingent consideration is measured at fair value at the reporting date, and it doesn't matter whether the contingent consideration is a financial instrument or a non-financial asset or liability. And any changes in fair value, other than those measurement period adjustments permitted within that 1 year of the acquisition date, those changes are actually recognized in profit and loss. For IFRS 8, I'm going to skip the amendment for now, as we have more details later on this one. And so continuing on the next slide, there were minor amendments made to IFRS 13 only in the basis of conclusion, so not in the actual standard itself. What the amendments do is they clarify that if you have short-term receivables and payables and there's no stated interest rate, these short-term receivables and payables can be measured on an undiscounted basis. So we expect that the impact is going to be quite low, actually, for most entities. On the IAS 16 and IAS 38 revaluation method, these amendments will actually interest those entities that use the revaluation method to account for their property, plant, and equipment and intangible assets of fair value. So what these changes do is it clarifies how you actually calculate the accumulated depreciation when you do use the revaluation method. And on IAS 24, this is the last amendment as part of the 2010-2012 cycle. So as you're aware, IAS 24, it is a disclosure-only standard. And what these amendments do is it clarifies that if you have an entity providing key management personnel services to the reporting entity or to the parent of the reporting entity, that is a related party of the reporting entity. So what we see this more commonly found is in investment funds. So the impact for other entities is likely to be low. The last 4 amendments were made as part of the 2011-2013 cycle. So for the IFRS 1 amendments, I won't talk about this one in detail as it only impacts first-time adopters. On the IFRS 3, I won't go into this one in detail as well, since it only impacts the standalone financial statements of a joint arrangement. The next one on IFRS 13, as you're aware, this is the guidance on fair value, and this amendment is to clarify the scope of the portfolio exception in paragraph 52. So as I mentioned before, some of these annual improvements make very narrow scope amendments, and this is one that falls into this bucket. As a very quick background, the portfolio exception, what it is it's a practical expedient which allows entities to measure if you have a fair value of a group of financial assets and financial liabilities. It allows you to measure this consistently with how the market participants would price the net risk exposure at the measurement date. So again, this is a very narrow scope amendment. The amendment clarified that you may have additional contracts that can apply this exception. And the last amendment on IAS 40, I'll speak more to on later slides. So in taking all of this into context, I think I can say that the good news is that we don't have any major changes in the standards, and the ones that I noted will only impact you if you have specific transactions. So the next few slides, we dive a bit deeper on two amendments that may have more of an impact. So the first one is on IFRS 8, and this is the standard on how an entity should report information about its operating segments. And there were two amendments made, and I'll start off with the first one, which was made to require more disclosures on how an entity would aggregate its operating segments. So on this slide, you'll see a very nice diagram as a reminder of some of the key definitions under IFRS 8 before we talk about what the new amendments are. So you look at this diagram. At the very lowest level, an entity may have some various operating segments, and these operating segments engage in business activities. These business activities and operating results are reviewed by the chief operating decision maker, and there's also discrete financial information that is available. So on this diagram, you'll see that we have identified 4 operating segments that have met this definition. And now taking this to another level higher, these 4 operating segments can be combined or they can be aggregated only if they share similar features in each of the following respects. So for example, if these operating segments have similar products or services, or they share the same production process, have the same customer base, distribution methods, or even, if applicable, the regulatory environment, this may indicate that they share similar features. Also, another point is that they also must share similar economic characteristics, such as performance measures and competitive, operating, or financial risks. So in our diagram, you can see that we have a red circle around operating segment 1 and 2 because they have met the criteria to be aggregated and disclosed as a reportable segment 1. Now, for operating segment 3 and 4 on the diagram, these have not been aggregated, so they are considered as separate reportable segments 3 and 4, respectively. So the importance of getting this right is that IFRS 8 has specific disclosure requirements for reportable segments, and also important to note that when you do your impairment testing for goodwill under IAS 36, this is actually not at the reportable segment level, but at the operating segment level. So it's really important to make sure that you identify the operating segments correctly, and then see if they met the criteria for aggregation. Also, we wanted to highlight that from a regulatory perspective, what we've seen also is that these segments are always a hot topic. We've observed that our Canadian regulator has in the past consistently raised comments on segments in their continuous disclosure reviews. We're also aware that the SEC's views on segments have also evolved over the last while. They've made observations that it's really important for entities to consider the qualitative factors when aggregating operating segments. So on this slide, we highlight what the amendments relate to. So before the amendment, an entity was only required to disclose the factors used to identify the reportable segments and the types of products and services from which each reportable segment derives its revenue. Now, after the amendments on the right side in green, you'll see that, well, you still have to make all those disclosures, but there's also added requirements to disclose the judgments made if you aggregated any of those operating segments. So what you have to do is you have to describe the operating segments that have been aggregated, and you also have to disclose how you assess that these operating segments have similar economic characteristics. So back on the previous slide, if you go back, you'll see that in this case, you'll have to make additional disclosures on the judgment you applied when you aggregated operating segment 1 and 2. So therefore, this amendment, we believe, will impact entities that have aggregated operating segments. So the second amendment made to IFRS 8 is around the reconciliation of the total reportable segment assets to the entity's assets. Now, before the amendment, this disclosure was required. We have included an example of a very simple reconciliation at the bottom of the slide. After the amendments, this disclosure is only required if segment assets is regularly provided to the chief operating decision maker. So what this means is if the chief operating decision maker does not review this information on segment assets, then no disclosure is required. So that's the good news. This next amendment on IAS40 investment property, it was made to eliminate the diversity in practice that is involved in how investment property should be accounted for. So before the amendment, some were in the view, one, that really that the standards were mutually exclusive, so that if you acquired an investment property and it had insignificant ancillary services, you could classify as investment property under IAS40 without the need to do the IFRS 3 assessment on whether this investment property was also a business. So that's one view. Others were in a view, too, and they believe, well, the standards are not mutually exclusive, and you need to look at both standards. Now, after the amendments, it's now very clear that view 2 is the correct view, and IAS40 and IFRS 3 are not mutually exclusive. So what this means is if you acquire an investment property, you need to assess if this is an acquisition of an asset or a business based on the guidance in IFRS 3. And, of course, significant judgment is required to make this assessment. So that's it for what's new for 2015. I'll continue next with an IFRIC update. As a quick background, the IFRIC stands for the IFRS Interpretations Committee, and the mandate of this committee is to review on a timely basis any implementation issues that have come up under existing IFRS, and also to provide guidance on those issues. And so the IFRIC members, they met in January, and they discussed a variety of topics, and they issued a number of agenda decisions. So we've only selected a few that we thought would have a higher impact, and I'll discuss those now. This first issue is on IFRS 12, which is the guidance on what has to be disclosed when you have interest in other entities. So, for example, in this case, what do you have to disclose when you have an interest in a joint venture or an associate? So specifically, the IFRIC was asked a question. They were asked to clarify the requirement on the disclosure of summary financial information. And so if you look at IFRS 12, there is a paragraph which says you have to disclose summarized financial information about certain balance sheet accounts and income statement accounts for those interests. And they've listed off various balance sheet items such as current assets, non-current assets, current liabilities, non-current liabilities, and also you're required to disclose income statement items like revenue, profit or loss, and other comprehensive income. So you can see on the slide, the diagram on the left is one view. So there's one view that says, do you disclose summarized financial information in aggregate, so in combination total for all material joint ventures or associates, or do you, in the second diagram on the right, disclose summarized financial information separately for each material joint venture or associate? Now, you can see that the difference in views is significant because if you had to disclose separately, then this obviously would result in substantially more disclosure. Now, the IFRIC discussed this paper, and they also said that it would be the second diagram to the right, that you would have to disclose summarized financial information separately for each material joint venture or associate. And what the IFRIC also does in some cases is that they do outreach to see if there is any diversity in practice. And what they found was that they actually didn't see any diversity in practice. And because of these reasons, they decided that they didn't have to make any amendments required to IFRS 12. They thought the guidance was clear, and because they also didn't see any diversity, they decided not to add this issue to their agenda. The next issue is on IFRS 13, which is the guidance on fair value measurements. And in this case, the IFRIC was asked to clarify whether prices provided by third parties would qualify as level 1 in the fair value hierarchy under IFRS 13. The actual specific question was on debt securities, such as government bonds that are traded in active markets, but are priced using third-party consensus prices. And so the IFRIC discussed this issue, and they said that, well, when you have assets or liabilities and they're measured on the basis of prices provided by these third parties, really what it comes down to is that the level in that hierarchy will really depend on the inputs that are being used by the third party to get those prices. So you don't focus on the pricing methodology that's used, but you have to really look closely at the inputs that those third parties are using. Now, if we tie back this to what actually IFRS 13 says, IFRS 13 says only unadjusted quoted prices in active markets for identical assets or liabilities can qualify as level 1. So therefore, if you tie everything together, if you have prices provided by third parties, they can only be categorized within level 1 if the measurement relies solely on unadjusted quoted prices in an active market for that identical instrument. So if there's any situations where the inputs are adjusted, then the prices would be classified as level 2 or 3. So the IFRIC thought, well, the guidance is pretty clear under IFRS 13. They didn't feel that any amendments were required, and so same with the other issue we just talked about. This issue was not added to their agenda. So the next section I will continue with is on upcoming changes. So these are changes that we are seeing in the pipeline that may have a significant impact. So I'll start off with IAS 19. So this issue has been bubbling up over the last few months and may impact entities with defined benefit plans. So specifically, the issue is how to determine the discount rate. So if you look at IAS 19, it says that the discount rate is a key assumption for defined benefit plans, and it's used when determining the defined benefit obligation. So this is the amount that's recorded on the balance sheet, and the discount rate is also a key assumption when you're calculating the current service costs, and this is the amount that is actually recorded in the profit and loss statement. Now, if you look closely at the guidance under IAS 19, in particular paragraph 85, it says that the discount rate should reflect the estimated timing of the benefits. And in practice, what we see is that a single weighted average discount rate is used. So recently, new actuarial approaches have emerged that allow for a more precise calculation of the discount rate under IAS 19. And what we see is that these approaches generally entail the calculation of different weighted averages for different plan member groups. For example, there may be a different discount rate applied to retirees and a different discount rate applied to active employees. Or some of these approaches actually have an even more greater degree of granularity. So ultimately what we are seeing is that the impact of the new approaches is on the current service cost that is recorded in the profit and loss. And in general, the discount rate will be higher for this cost component, resulting in a lower expense in the profit and loss. While some actuarial approaches emerging are considered acceptable, this is not all the case for all the approaches that have been under discussion. So, for example, the vector approach is not permitted. And we also note that if you continue using a single weighted average rate, this is also acceptable. And just to be very clear, the new approaches are optional considerations, and they're not required changes. And in the situation where if your entity wants to change their approach, our Deloitte Canada view is that this would be considered a change in estimate under IAS 8. And IAS 8 is the standard on accounting policies, changes in accounting estimates, and errors. So our main message that we want to get across is that if you are thinking of changing your discount rate approach, we really recommend that you discuss with your professional advisors. The next upcoming change is on classification of liabilities. So for those of you that can recall, when we transitioned from Canadian GAAP to IFRS, there was a difference on how liabilities would be classified if an entity breaches a covenant and the timing of when they got the waiver. So under old Canadian GAAP, if you go back a few years, you look at EIC 59, if you got a waiver after the reporting date, but before the financial statements were issued, the debt could still be classified as long-term. However, under IFRS, the debt would be classified as current because if you look at the end of the reporting date, the entity does not have this unconditional right to defer settlement for at least 12 months after that date. So, for example, if you had a December calendar year-end company and they breached a covenant on or before December, but they obtained a waiver on January 10th, so this is after year-end, but before the statements were issued, under old Canadian GAAP, the debt would be classified as non-current. However, under IFRS, the debt would be classified as current. Now, this is the guidance under existing IAS1, and on the next slide, you'll see what the proposed changes are. So there was an exposure draft that was issued in February this year on proposed amendments to IAS1. So in particular, the IASB wanted to clarify the guidance under IAS1 on when you would classify liabilities as current or non-current. So as a quick background, if you look at two certain paragraphs under IAS1, there appeared to be a conflict between these two paragraphs. If you look at one paragraph, paragraph 69B, it says a liability is classified as current when the entity does not have an unconditional right to defer settlement for at least 12 months after the reporting period. So the focus here is on unconditional. Paragraph 73 actually uses the word discretion. So if you see this definition under this paragraph, it says a liability is classified as non-current when an entity expects and has the discretion to refinance for at least 12 months after the reporting period. So there's some confusion on, well, how can an entity have an unconditional right but also have the discretion? So some of the main proposals are, number one, to align the paragraphs 69D and 73. So for paragraph 69D, this proposed amendment suggests to remove unconditional. So it will say a liability is classified as current when the entity does not have a right to defer settlement for at least 12 months after the reporting period. Under paragraph 73, this proposed change is to replace discretion with right. So it will say a liability is classified as non-current when the entity expects and has the right to refinance for at least 12 months after the reporting period. The second proposal is also to make clear that when you're looking at the current versus non-current classification, it's based on the rights that exist at the end of the reporting period. So really it's a point-in-time assessment. And the third proposal is to add a new definition for settlement to include the definition that settling a liability by transferring equity instruments would also meet that definition. So what we are actually hearing is that the exposure draft is causing some significant concerns, and some view that the exposure draft has failed on a number of points. The first concern we're hearing is that the exposure draft has not dealt with the issue of covenant breaches and covenant tests after year-end. So there's a view that, well, if you remove the word unconditional, that's not sufficient to address how an entity deals with a situation where, well, there's no breach at year-end, but what if, they come to Q1 and they expect that they will be in breach and they will require a waiver in order to avoid the debt being called? What do you do in these circumstances? So we've seen this question come up a number of times as quarterly covenant calculations are fairly common in Canada. Secondly, an area that's also causing significant concern is the new definition of settlement, and this includes a settlement it includes in the definition settlement by transferring equity. So based on this, it would appear that if you have convertible debt, when there's a conversion option that can be converted at any time by issuing equity instruments, that would meet the definition of settlement and would be required to be classified as current. So this is causing concern because we're aware in Canada we see a lot of entities issuing convertible debt. So these proposed amendments may have a significant impact on these entities with these instruments. So if you wish to comment on these exposure drafts or you share some of these concerns on these proposed amendments, the comment period is open until June 10th, so you still have a bit of time, and you can submit your comments or concerns through the IASB's website, and we provided a link at the bottom of the slide. So John, those are all the updates that I have. I'm going to turn it back to you for our next polling question.
That's all, Ann? Lots of stuff in there. Obviously, it's not easy following them and making sure you don't miss anything. Anyway, okay, let's move on to our second polling question. How closely do you monitor the discussions of the IFRIC? We listen to the playback. We wait to read the meeting notes. We rely on other information sources like Deloitte webcasts, or not closely at all. Remember to click on Submit Answer. While we're waiting, there is a question for you, Ann. Where can we get access to the minutes of the IFRIC discussions?
So that's a good question, John, and sometimes I struggle with this as well because sometimes the hardest part is really keeping up with all the discussions and all the changes that are taking place. Especially for the IFRIC, the best place is to go directly on the IASB website, and if you go www.ifrs.org, it's very simple. Go to Updates, and IFRIC updates, and you'll see the minutes to the meetings being posted. So they're usually very quick, and within approximately 2 weeks of the meeting dates, the minutes are posted. So this is actually quite timely.
Good, thank you. Okay, let's have a look at our polling results. We rely on other information sources like Deloitte webcasts. Okay, we've got a loyal audience here, 70% in that category. I do note that 15% say not closely at all. Later on, I think Carrie's going to comment on some IFRS discussion group observations around IFRIC rejection notices. I'd now like to welcome our second speaker, Maryse Vondet. Maryse is a partner in the Global IFRS and Offering Services Group and is also co-leader of the Canadian Centre of Excellence on IFRS. She's been with the firm for over 20 years. Maryse has spent the past 10 years offering accounting and consulting advice to both public and private companies. Over to you, Maryse.
Thanks, John. So continuing on the topic of upcoming changes, there's also been a narrow scope amendment to IAS 16 and IAS 38 as part of the annual improvements project that are meant to clarify what are the acceptable methods of depreciation for property, plant, and equipment and amortization for intangible assets. But for a bit of background before we get started on the topic, the IASB received a request for guidance on how to determine what's an appropriate method of amortization for intangible assets of service concession arrangements under IFRIC 12. For example, you can think of an intangible asset that represents the right to operate a toll road. The boards quickly concluded that the issue is not limited to those types of assets, but also applies to all tangible and intangible assets that have a finite life. So effectively, the amendments would restrict significantly the circumstances under which a revenue-based amortization method would be appropriate. So what are we talking about here? We're talking about, a depreciation method or amortization method where it's based on the revenue in the period in proportion to the total expected revenue over an asset's useful life. So some of the highlights of the amendments that you can see on the screen. First of all, for property, plant, and equipment under IAS 16, the amendments would prohibit the use of a revenue-based depreciation method. For intangible assets under IAS 38, the amendments effectively create a presumption that revenue-based amortization is not appropriate, but this presumption can be overcome in limited circumstances as indicated on the slide. So those circumstances include, for instance, the first one, when the rights related to the intangible asset are expressed as a measure of revenue. So you can think of a situation where an entity has a right to maybe operate a mine and extract mineral from a mine until it reaches a cumulative amount of revenue. Or the same thing for when an entity might have a right to operate a toll road until it reaches a cumulative amount of toll revenue. Another circumstance where it might be appropriate is if you're able to demonstrate that revenue and the consumption of economic benefits of the asset are highly correlated. Now, highly correlated is not defined in the amendments, but the amendments do indicate that that would be the case if using a revenue-based amortization is expected to give the same answer as if you'd use another allowable amortization method such as straight line or diminishing balance, for instance. So moving on, what are the underlying reasons for the amendments? So IAS 16 and IAS 38 both indicate that there's various methods that can be used to amortize an asset over its useful life. And they mention a number of different methods that are available. But the objective is to choose a method that would reflect a pattern of consumption of the expected future economic benefits embodied in the asset. So using revenue generated by the use of the intangible asset does not reflect the consumption of economic benefits, but rather how the asset generates economic benefits. And this would generally reflect factors that are not necessarily directly linked to the consumption of economic benefits of the asset. You can think of, selling activities that changes the sales volumes. You can think of changes in sales prices, including the impact of inflation, for instance. So the amendments would be effective on a prospective basis for annual periods beginning on or after Jan 1st, 2016. Early application is permitted. So we've noted here some consideration points that you might want to think about. So first of all, do you currently use a revenue-based amortization method, either, directly based on revenue or indirectly based on revenue? And, that may be more common in certain industries like the media and entertainment industry that historically, used potentially more of this type of amortization method. And if that's the case, then you may need to review your policy and determine if you can overcome the presumption that you can use the revenue-based amortization method. And so some questions you may ask yourself in that exercise are, are the rights embodied in the intangible asset expressed as a measure of revenue? So, what is the principal limiting factor of the intangible? Is it a revenue-based factor, or is it something other like time-based or volume-based? Is revenue and consumption of economic benefits highly correlated? For example, is revenue earned evenly such that a straight line amortization makes sense? Other questions that you might also want to consider that the amendment does bring up, which might have an impact on your depreciation or amortization method, is it expected that the selling price of an item produced using an intangible asset will decrease significantly over time? And if that's the case, that may indicate, technological obsolescence or whatnot. And what's the impact of that? And is the intangible asset used in multiple activities to provide multiple revenue streams? And if that's the case, then is there an opportunity to componentize the intangible and amortize differently? So those are some of the things that are raised in the amendments. I would suggest that if it has a potential impact on you, you take a read through it.
Okay, so looking ahead, I will now cover IFRS 15, revenue from contracts with customers. As you are likely aware, in May 2014, the IASB and the FASB jointly issued Revenue from Contracts with Customers, a converged standard that introduces a single comprehensive framework for revenue recognition. The standard is currently mandatorily effective for annual periods beginning on or after January 1st, 2017, and early application is permitted under IFRS. The core principle of the standard is that an entity recognizes revenue to depict a transfer of control of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. And in applying this core principle, the new standard introduces a new 5-step model for revenue recognition, as you can see on the screen in front of you. So first of all, the entity has to identify the contract with the customer, then identify the performance obligations in the contract, determine the transaction price, allocate that transaction price to the various performance obligations, and finally recognize revenue as those performance obligations are satisfied. So although we'll focus our discussions today on only certain aspects of the recent board discussions, it's important to note that this new standard is comprehensive and in the sense that it deals with revenue from contracts with customers, but also introduces a number of specific disclosure requirements and guidance related to contract costs. And if you're looking for a more general overview of the standard, we encourage you to refer to our June 2014 webcast specific to this new standard, which is listed as a resource at the end of this section. Many entities have begun putting into motion their implementation plans, and in doing so have also begun to encounter application issues and challenges when interpreting the standard. So in order to assist with addressing these concerns, the IASB and the FASB jointly established a transition resource group for revenue recognition that we often refer to as the TRG. So the TRG solicits, analyzes, and discusses stakeholder issues arising from implementation. Although those discussions are non-authoritative, the TRG does identify issues in which they believe the standard may not be clear and where further consideration is required on the parts of the boards. So to date, the TRG has met 4 times, actually meeting a 4th time March 30th. The papers are available on the IASB website. Based on these meetings, a number of topics have been brought to the attention of the boards and have since been discussed at their February and March 2015 meetings. So there's, more or less 20 or so issues that have been discussed thus far at the TRG. We've listed here those that have been raised to the boards for further discussion. And today, we'll briefly touch on two of those issues, items 6 and 7, on the slide in front of you. At the February 2015 joint board meeting, the boards discussed the topic of distinct in the context of the contract. To provide some background on this issue, if you recall, Step 2 of the standard requires entities to identify performance obligations, or if you will, the deliverables in their arrangements, the distinct goods or services promised in a contract. And in assessing whether a good or service is distinct, the standard includes two specific criteria that both must be met. So the first one, the good or service must be capable of being distinct, meaning the customer can benefit from the good or service on its own or together with other readily available resources. This is similar to the standalone value concept that you may be familiar with. Often, if an entity regularly sells the good or service separately, that's a good indicator that the good or service is capable of being distinct. The second criteria introduces a new concept that requires the good or service to be distinct within the context of the contract, meaning is the good or service separately identifiable from other goods or services in the contract? And to make this determination, the standard includes factors to consider that we've listed here on the screen. So is the entity offering a significant service of integration of the various goods and services? Is the entity significantly modifying or customizing the goods and services? And are the goods and services highly dependent or highly interrelated on each other? So it's on the application of this second criteria that questions were raised with the TRG. More specifically, there is diversity in views as to how entities interpret what it means for a good or service to be highly dependent on or highly interrelated with other goods or services promised in the contract. So the staff have prepared a paper that analyzes this issue, and the paper includes an example which we've illustrated here on the screen, whereby equipment or a machine requires installation at a customer's premises. And assume this installation is a relatively simple process that does not require any substantive modification to the machine. So the question that can be asked is the machine and the installation services separately identifiable, such that they would result in two performance obligations? So some entities believe that because the machine would not function without being installed and or the installation service are dependent on successfully transferring the machine, the promise to transfer the machine and the installation service are a single performance obligation, whereas others would view this as two separate performance obligations. So in analyzing this issue, it was noted that it was not the board's intention that every good or service that might be regarded as highly dependent on or highly interrelated with another should be combined. The relationship between the goods and services that they were aiming to capture by creating this criteria is a transformative relationship between the two items in the process of actually fulfilling the contract, rather than the functional relationship between the two items. So if we apply this logic to the example we discussed, the staff believe that the machine is separately identifiable from the promise to install the machine. Although there is a functional relationship between the machine and the installation, the entity could fulfill its promise to deliver the machine without having to install it. And similarly, the entity could fulfill the same installation service even if the customer had not acquired the machine from this entity. So the boards acknowledge that, this area requires judgment. Given the concerns raised by the stakeholders, the ISB agreed some additional examples could be helpful to illustrate the application of the criteria distinct within the context of the contract. It was also important to note that the FASB, in addition to providing additional illustrative examples, plans to amend the equivalent guidance under U.S. GAAP by expanding the articulation of what it means to be separately identifiable. And so what we encourage you is stay tuned for further changes in this respect from the FASB and the ISB in terms of evolution and articulation in the standard. I'll now cover the board discussions on licenses. Contrary to existing revenue guidance, IFRS 15 now has specific detailed guidance related to licenses of intellectual property, and that may include licenses such as to software and technology, motion pictures, franchises, trademarks, copyrights, etc. As a reminder, under IFRS 15, in accounting for a license, entities must first determine whether the license is distinct. So using the same criteria that we just previously discussed under Step 2 of the model. If it's concluded that the license is determined to be distinct, entities must account for the license as a separate performance obligation and must determine whether the nature of the license is to provide a right to access the intellectual property, which would result in overtime recognition of the license revenue, or if it's in the nature of a right to use the IP, which would result in a point-in-time recognition. And if it's concluded that the license is not distinct from other goods and services in the contract, the license will have to be bundled with the other promised goods or services in the contract, and an evaluation of the pattern of recognition based on the transfer of the bundle of goods and services will have to be made. With that as background, in assessing the nature of a license, an entity must determine if specific criteria are met that would demonstrate that the nature of the license is a right to access recognized over time. Otherwise, a license is in the nature of a right to use recognized at a point in time. So the criteria listed on the screen here are based on whether the contract requires or a customer reasonably expects that the entity will undertake activities that significantly change the IP to which the customer has rights, and whether as a result of those activities, the customer is exposed to positive or negative effects of those activities, and whether those activities do or do not result in the transfer of a good or service to the customer as they occur. If all those criteria are met, then the license would be in the nature of a right to access. Now, questions have arisen as to how an entity will determine if the IP is significantly affected by the activities of an entity. And specifically, does this require a change to the form of the license, its functionality, its value, or all those factors? So the boards were presented with a staff paper that analyzed the issue of how to determine whether the entity's activities significantly affect the IP to which a customer has rights. The example presented to assist in understanding the issue in that paper was one where the TV production company licenses season 1 of its show to a customer. Concurrently, the TV production company undertakes a number of promotional activities for season 2 of its show that is currently being produced. And there were 3 possible views that have been raised in assessing the entity's activities, in this particular case, the promotional activities, and whether they significantly affect the IP. And those views are demonstrated by the 3 boxes that you can see on the screen. So some believe that the intent was that significantly affect was meant to capture more than just changes in the form or functionality, but not all the changes in value of the underlying IP, which may seem to be view C on the screen. In the end, after some deliberation, the staff proposed that activities would significantly affect the IP when those activities define the IP and significantly change the utility of that IP. So with that in mind, in the above example, the promotional activities undertaken would not affect the utility of Season 1 in this case. Season 1 has substantial standalone utility, and although there could be an effect in some way on the value of Season 1 because of the promotional activities, this does not affect the underlying utility of the license for Season 1. So the boards have agreed to amend IFRS 15 to incorporate an explanatory paragraph which would include that first, activities significantly affect the IP when those activities affect the utility of the IP. And secondly, utility would be affected when activities affect the form, that means the design of the IP, or its functionality, so the ability to perform a function or a task. Utility of the IP is also substantially derived from those activities. So, for example, the utility of a brand would be affected by ongoing activities of an entity. But there's a presumption that if the IP has significant standalone functionality, like that may be the case, for example, for some software, the utility of the IP is derived from that functionality and is not affected by ongoing activities. It's important to note that the FASB is taking a slightly different approach here in terms of classifying licenses as between those that are symbolic versus functional, and this may lead to some different classification of licenses for certain items such as brands. So we would encourage you to stay tuned to the changes or modifications that may come about from this discussion from an IASB perspective and a FASB perspective. Finally, on resources, just want to bring to your attention a few of them. So as I said before, if you're looking for a good high-level understanding of the requirements of the standard, we encourage you to listen in to the replay of our webcast, Bringing Clarity to an IFRS World, from June 2014. And we also encourage you to take a look at the IFRS in Focus publications and Heads Up publications, which provide good summaries of TRG discussions and board discussions related to IFRS 15. So that completes it for me. Thank you very much.
So first of all, the classification and measurement. So that's one of the first things that they did in the new standard, classification and measurement of financial assets. So this is the part of the standard that you would look to understand whether your financial assets are measured at amortized cost, fair value through profit or loss, or fair value through other comprehensive income. So those categories all sound very familiar, like we've had them before. The difference is how you get to the different categories, and now it's a twofold test. It's the business model for why are you holding the financial asset and how is that portfolio being managed, as well as what are the attributes of the instruments themselves. And so when you go through those tests, you come out at the end with what the classification should be. So I'm not going to go into details on all of that. It could be the subject of a whole nother presentation, but just to give you a flavor for some of the things that are covered in the standard. Classification and measurement of financial liabilities is also addressed in the comprehensive changes. Not really a lot of changes, except for it does speak to how parts of the fair value change get recorded in other comprehensive income instead of in profit and loss if you happen to be designating financial liabilities at fair value. The comments on embedded derivatives really relate back to the classification and measurement of financial assets. So under IAS 39, as some of you might be painfully aware, we need to look for embedded derivatives in our financial assets and financial liabilities and all sorts of contracts. When it comes to financial assets under IFRS 9, these will no longer be considered separately, but they'll be considered as part of the attributes of the financial asset itself, which will, again, as I said, drive out classification. So generally speaking, if you had an embedded derivative that would be separated under IAS 39 before, under IFRS 9, that would drive the whole instrument to being carried at fair value. No changes to the how amortized cost gets applied. So if you have something at amortized cost, there's no changes to the mechanics of how that gets done. Impairment. So here's an area where, depending on who you are, could be a big change. So here, the notes are that it's a change to an expected loss model. So what the IAS 39 is what's known to be called right now an incurred loss model, moving to an expected loss model, which effectively means that credit losses will tend to be recognized earlier. So also, all the way to the point that you could have a credit loss recorded on a financial asset sort of the moment or the day after you first recorded it. So much earlier recognition there. Now, don't be too alarmed if all you have is trade accounts receivable and maybe some investment grade investments. The changes will not be all that big for you, but depending on who you are, it could be a big change for those with other kinds of instruments and loans and so on. Hedge accounting. So here's probably the number one reason for people to maybe want to early adopt. And this is because hedge accounting has become more user-friendly, so easier to manage, easier to maintain, more kinds of hedges will be able to qualify for hedge accounting. The stated objective of the standard is to have hedge accounting more closely reflect the way companies manage their risk, and so to be able to get hedge accounting in more of those risk management type of strategies. So moving on to the next slide, it's a complicated slide, and it talks about the different versions of IFRS 9. And because IFRS 9 was issued in a number of different phases, this has really complicated somewhat the transition to IFRS 9. So at the top of the slide, the top sort of 3 arrows there basically relate to the earlier phases of IFRS 9 that have been released. And then the middle box there, which is the 2014 version, that's kind of the final word on IFRS 9 that was issued last July. So until, sort of for a limited time now, entities still have the ability to adopt earlier versions of IFRS 9. That ability runs out after January of this year. So effectively what that means is if somebody wanted to adopt IFRS 9 starting this quarter, so January 1st, 2015, they could do so, and they could do so choosing an earlier phase. So let me give you an example. So if you decided you wanted to adopt IFRS 9 to get the hedge accounting standard, that came out in the 2013 version, and so you could say, well, right now, January 1st, 2015, first quarter 2015, I'm going to adopt the 2013 version. So that means you take all the earlier versions and you'd get hedge accounting, but what you would avoid is having to do the impairment standard, which was issued in July. So would there be any advantage to that? I guess it would depend on how complicated you thought the impairment standard would be for you to adopt. So it is a bit of a choice. You can get hedge accounting without taking the impairment standard, but then that just sort of gives you 2 adoptions that you need to go through anyway. So you probably really have to weigh that. Probably on balance now, I think it may make the most sense to just adopt the 2014 version, as long as you don't think you have a lot of complicated impairment issues. And then the bottom part of the slide just allow for there's further complications, I guess, in the transition. The application of the own credit risk requirements, so that's where you fair value measure your financial liabilities, and you can record, or you do record, the credit risk adjustments related to those financial liabilities through OCI. That can be early adopted all the way up to the date, January 1st, 2018. So you could just take that one change. And then, as if it's not confusing enough, you could actually adopt IFRS 9 even into 2018 without taking the new hedge accounting standards. And that's because the ISB is still working on their macro hedging standards. So they're not forcing people, if you don't want to take the hedge accounting standards until the macro hedging is done, you can stay on IAS 39 for hedge accounting. Probably not a lot of advantages to doing that, in my view, but it is definitely available. So the next slide talks about basically the date. So what date are we talking about? January 1st, 2018. And how does the standard get adopted? It's a retrospective application. So that means you basically need to catch up your accounting to what it would be as if you'd always been under IFRS 9 or the parts of IFRS 9 that you're adopting. And here's the trick a little bit. You do have a choice about whether or not you restate your comparatives. So let's take an example. Say somebody wants to adopt January 1st, 2016, so next year. That would be January 1st, 2016. It's a calendar year company. So that would be considered their date of initial application. And that's an important date because a bunch of things need to be assessed on transition as of that date. So that's your date of initial application if you pick 2016 as your starting point. But you still have the decision about whether or not you would restate 2015. So if you decide not to restate 2015, you sort of catch everything up at January 1st, 2016, and it's probably an easier transition, but you have to recognize that 2015 and 2016 might in some respects be on a different basis. On the other hand, you could restate but the date of initial application is still considered to be January 1st, 2016. So that's the date that you make a bunch of assessments that I'll talk to you about in the next slides. But it does make it a little bit complicated because you've got the date of initial application and making all those assessments, and yet you might decide to still restate the earlier period. So that's actually raising a lot of questions for people who are really taking a hard look at the standard and how they're going to adopt it. So the next slide goes through, and the transition requirements are set out in sort of in chunks based on the part of IFRS 9 that you're thinking about transitioning to. So the first one I'm going to talk about is the classification and measurement standard for financial assets. So this one, basically, as I said, it's a business model. It's a combination of assessing the business model, why you're holding the financial assets, as well as the attributes of those financial assets. You can see that middle box. It's called SPPI criterion. So that stands for solely payments of principal and interest. So that's an attribute of the instrument. So, for example, we would say that a vanilla bond with no embedded derivatives or embedded features would likely be considered an instrument that has solely payments of principal and interest. So those are the main candidates for investments that can end up being categorized as amortized cost. But you do still need to layer on the business model test to understand that for sure. So basically, you're making all of these assessments, the business model assessment, the attributes of the instruments that you're holding, all at that date of initial application. So again, going back to my January 1st, 2016 transition example, you would assess your portfolios of financial assets in the business model test as of that date. So then you would even push back. If you wanted to restate, you'd presume that business model for that particular portfolio had persisted all the way through 2015, and you wouldn't rethink that and reconsider that. So it does make it makes for some interesting, I guess, questions around the transition. It's kind of tricky, and it's a little bit different than others that we've seen in the past. And then the bottom box, I guess the bottom middle box talks about the fair value option designations. So you still have the ability to designate financial assets at fair value through profit and loss if they don't otherwise qualify for that treatment. But again, that designation is made based on what you're holding at, in my example, again, the January 1st, 2016 date. So that just gives a little flavor for the classification and measurement transition considerations. On to impairment. And so here, and again, this one is going to be maybe this part of the standard, impairment, not such a big deal for many, but a very big deal for some, I guess. So as I'm talking about some of the complexity, it's more aimed towards those companies that are holding a lot of longer-term amounts receivable, complicated investment portfolios, and so on. If you're just holding accounts, trade accounts receivable, short-term accounts receivable, interest-bearing investments, generally of investment-grade quality, it won't be as complicated. But again, back to the discussion of the date of initial application and my hypothetical January 1st, 2016 adoption, you need to look through all of the financial assets to which this standard applies, the impairment standard applies. So basically anything at amortized cost or anything at fair value through other comprehensive income. And you have to consider basically the credit situation related to those instruments at the January 1st, 2016 date of initial application. And really, once you get into the standard, or if you have already, you'll know that what drives the standard and the impairment is the consideration of whether there's been a significant increase in credit risk since the date that the instrument was initially recognized. So the transition part of the standard is really asking the question of all those things that you're holding on my January 1st, 2016 date of adoption, have they significantly increased in credit risk since the initial recognition. So initial recognition could be a very long time ago or some time ago, and so they do allow a practical expedient, kind of talking about if you can't make that assessment without, and these are the words from the standard, undue cost or effort, then you can presume that basically you end up presuming that they have had a significant increase in credit risk, and you get pushed into the bucket where there would be more credit losses recorded. So that's just a little flavor for what might happen on transition to the impairment part of IFRS 9. But, it is a complex area and will require a fair bit of work by those entities that have a lot of instruments that are longer term and have more, credit challenges potentially. So getting outside of the high credit quality investments. And on to the transition requirements related to hedge accounting. And so these are probably the most simple out of all of the transition requirements for the standard. And so essentially, as the slide says, the hedge accounting requirements are applied prospectively, but I want to make a couple of comments about that. So first of all, you might say, well, okay, prospectively, that means I start the accounting when I adopt the standards. So back to my example, January 1st, 2016. That's true. But one thing to say about existing hedging relationships, so you might have some existing relationships under the prior standard that you're getting hedge accounting for under IAS 39. And so you're probably wondering whether you can continue those. Well, yes, you can. So that's sort of it's not affected by the fact that the standard is a prospective standard. Your hedges that continue to qualify can continue to get hedge accounting, broadly speaking, uninterrupted under IFRS 9. So that's a bit of a caveat to the prospective application. The next category on the slide, a new hedge relationship. So, and this is where, as I said, this is where a lot of people are looking to adopt IFRS 9 because they can get some new hedging strategies to get hedge accounting. And so these are the ones where really it is prospectively because you can't start your hedge accounting until your documentation is in place. So back to my example, somebody doesn't adopt till January 1st, 2016, and there I'm presuming that they don't have IFRS 9 hedge documentation in place until that point, and so they couldn't start hedge accounting until they have done all that. And then finally, the last part of the slide is really just pointing out that I guess it's theoretically possible that you might have an IAS 39 hedge, so a hedge under the old standards that doesn't continue to qualify under IFRS 9. We haven't really been able to think of a good example of that yet, and so I'm kind of thinking that it should not happen, but I suppose it's a theoretical possibility, and so those would have to stop. So basically, in a nutshell, those are the transition requirements. As you can see, they're fairly complicated, and they do take a fair bit of study. And, the thing is, you might read them and go, yeah, okay, I can kind of see it. I sort of get it. And then once you start thinking about it in the context of a particular portfolio or instrument or something, you might start to have more questions arise. So, it's good to start thinking about some of these things early, even if you're not planning on a January 1st, 2016 implementation, and maybe you're going to wait a bit longer. So just to sum up on this slide, some key considerations. So mandatory date, January 1st, 2018. Early adoption is still possible for the first quarter. If anybody is doing a transition for the first quarter of this year, there are some choices, or more choices, I guess I'll say, about which version to take. But once we get through the first quarter, those choices are gone, because starting February 1st, 2015, anyone early adopting really needs to take the whole standard, except for the fact that what I mentioned before is they don't need to take hedge accounting if they don't want to. The next comment, classification and measurement of financial assets. Just a reminder that, we get to similar categories as we've had before in terms of recognition and measurement. It's just the way that you get there is different. The business model test tends to be a portfolio-based test. So you'd be looking at assets grouped together if that's the way you're holding your assets. And then the solely payments of principal and interest criterion, that is at an instrument level. So you have a little bit of a combination test there in order to decide whether instruments are at amortized cost or fair value. Classification and measurement of financial liabilities, as we mentioned, no really significant changes there. Impairment, so, again, just to say again that really what you're monitoring in the impairment standard largely is whether there's been significant increases in credit risk since you first got the instrument, and so that really drives when you have to record more credit losses. And then hedge accounting, as I said, probably the number one reason why people are looking to early adopt. It creates some new opportunities for hedge accounting. And the next slide, just to go into that in a little bit more detail, some of the advantages of early adopting. So what are some of these areas where we might be more likely to get hedge accounting? Commodity price risk hedging might be easier. It's the standard is much more user-friendly to those kinds of hedging strategies. Hedging net positions, so especially in currency, when we have, let's say, U.S. dollar inflows and outflows, it's going to be easier to hedge that on a net basis if that's how you're managing the risk. There is some more favorable accounting for hedging involving options and forwards for those kinds of hedging strategies in terms of being able to take the time value or the forward points or at least some part of it through other comprehensive income instead of taking the changes in those values through profit and loss. There's a more relaxed approach to assessing effectiveness. So if you're doing hedge accounting under IAS 39, you'll know about the 80 to 125 test, and that's the band within which your hedge effectiveness needs to sit. Otherwise, you violate hedge accounting and you can't continue to hedge accounting, or if you don't have that at the outset, you can't even start hedge accounting. There are no such numbers appearing in IFRS 9. There needs to be an economic relationship, and so that's what we consider, but there are no bright line tests or anything like that. So managing and assessing hedge effectiveness is going to be a lot easier under IFRS 9. Other considerations, so just let's say you do want to early adopt, or even if you're not early adopting, thinking ahead to 2018, what do you need to do? I think that depends a little bit on who you are and what you have, and if you are going to, if you're thinking about early adopting, what would be your reasons and so on. But, as I said, the transition provisions are complicated, and here's a point that I didn't mention previously. They explicitly prohibit the use of hindsight. So here's an area where we need to be careful. If you do want to restate, which some will do because they won't like the idea that, back to my example of a 2016 adoption, they wouldn't like the idea that 2015 maybe is on a different basis because it hasn't been restated. But you can only restate if you can do so without the use of hindsight. So one of the things that might mean is even before, in the year or two before your date of adoption, start collecting data and analyzing things under an IFRS 9, the way you would expect to under IFRS 9. So you're collecting that information so that it cannot be said later that your application used hindsight because you've collected the information and the data and made the conclusions kind of real time as events were unfolding. So, just some things to think about. Would you want to restate? And if you are, what's the historical information that you're going to need to collect? Processes and system changes. So do you need to make changes to your systems to even be able to collect that stuff? Internal controls and hedge accounting, certainly an area that a lot of people are looking at. The next page has the resources, similar to what Marie's went through. We have a number of IS Plus publications that you can find on isplus.com. And we did also do a webcast last June around hedge accounting. So anyway, just some resources for you to think about. The last one noted, called ITG Meetings and Summaries, that is a group. So Maurice was talking about the TRG for revenue. The ITG is a group, an international group of practitioners and industry people who are going to be dealing with primarily impairment issues as they relate to adoption of IFRS 9. And they will, like the TRG, have public meetings and publish their notes and so on, and refer issues to the boards as necessary. Okay, so switching gears away from IFRS 9, we are going to have finally, one of our last sections is going to be the IDG update. So remember, the IFRS discussion group is a non-authoritative group of the Canadian Accounting Standards Board. Their job is to, their mandate is to identify and discuss issues arising on application of IFRS in Canada. So they meet a number of times a year, probably every couple of months, and they their meeting notes are published. The last meeting they had, well, I think they had one in March, or about to have one, but before that there was one in December, and the notes to that meeting are available on the FRAS Canada website. So I'm just going to talk to you about a couple of these things that were discussed in December, and you can, as I said, you can easily go and see the other topics at any time on the website. So the first thing, and I think John alluded to this, the first one I was going to talk to you about was the role of non-authoritative guidance. So the question that the group considered here is, should Canadian preparers consider non-authoritative guidance when preparing their financial statements? So things like IFRIC rejection notices, and as well ISB and IFRIC staff papers and educational materials. So earlier, Anne talked to you about a couple of IFRIC rejection notices. And what we see in those things is even though the IFRIC does not take the issue on, so they don't change any standards, or they don't authoritatively issue any new standards, when they issue their rejection notice, they often give us clues to how they think the current standards as written should be applied. So back to the example about IFRS 12, and to what extent could you aggregate the disclosures of associates and joint ventures. And basically you could see they said, well, we don't think we need to deal with this. And by the way, we think it's clear that you should be providing the disclosure on an individual investee basis. So even though they don't change a standard, they do give us some important clues about what the thinking is, or the standards that are thinking is, on the way the existing standards should be applied. So, they are fairly important sources of information about, how standards should be interpreted, or they can be. I mean, some of them are. That's the other thing to note about them, and I think the IDG also mentioned this, is sometimes the issues are a little bit that they talk about are a bit more obscure, so they don't have broad application. So you need to use them a bit carefully, but it is definitely a source that we look at a fair bit. There is a bit of rigor to them as well, because they publish the draft. Whenever they do a notice, they'll publish the draft of it, and people will write in comments, and oftentimes based on the comments, they'll actually make some changes to how they're phrasing or framing the issue. So they do go through some process. I think the staff papers and educational materials, they're also interesting, but they're the materials that the board and maybe the IFRIC is using in their deliberations. So you really need to, when you use them, you kind of need to also look at how it turned out in the end as well. So you might need to go look at meeting minutes and so on. But I guess the question is, do you have to look at them? And that's really what the IDG was asked. And so there were a few different views put forward. You should follow them, not required, it depends. I think that, I think the views were somewhat mixed. I think, it's true, it's not authoritative guidance. It's something that could be looked to, and it depends on how closely your situation matches what's in that IFRIC rejection notice. So I think, use them with care. Definitely, we use them as we're looking at client issues. So I think they are an important source, and but definitely not a one-size-fits-all answer there. The next one, IFRS 5 and IAS 36 interaction. So this one basically asks the question, you have a cash-generating unit that's likely to be sold, but it hasn't met the criteria to be called a held-for-sale asset yet under IFRS 5. Do we include the sale or the proceeds realized to be realized on sale in the value in use calculation? And so the answer that the group came to was essentially yes. It may be appropriate to probability weight the cash flows, basically taking into account the idea that maybe you don't know exactly, that your certainty around the proceeds might be not that high, or maybe you're not entirely sure that it's actually going to be sold, but it is certainly something to be looked at. The next one, capitalization of costs under IAS 16. So this is an important area to understand when you're constructing assets yourself. Basically, the important question is, when do I stop capitalizing and start depreciating? And so this is what the group considered. And they considered three views. One being use a predetermined operating level. So an example of that would be, I'll stop capitalizing and start depreciation when I reach a certain percentage of capacity. And I think that's a common one that we see in some industries. Another one would be just, as soon as we can start creating output, that's when we switch over to depreciation. And then the third view is accounting policy choice. I think, not surprisingly, the views on this one with the group were a little bit mixed. People felt that the second view, when you can start creating output, that seems to be the most conceptually pure. But I think recognizing that in certain industries, the percent of normal capacity is maybe more appropriate. So, interesting issue, and certainly refer you to the notes on that one. And, I guess the other thing to mention is that the group decided that they would raise it with the Accounting Standards Board should raise it to the IFRIC, which has been done. And I believe the IFRIC is also still considering this issue. Okay, just in the last couple of minutes. So just to look ahead to the we've got some recently issued amendments available for early adoption, so we talked about a lot of them. Probably won't say that much more except for the last one. Just to note that one, they're also looking at a similar issue in the standard setting activities, and so they've noted on the IFRS 10 and IAS 28 one that the effective date for that one may be deferred. But it is still technically available there as a final standard. It's just that they might be looking at a closely related issue that may cause them to defer the effective date. And then we have some more narrow topics on the next slide, which I won't go through. And then finally, I guess the last thing I'm going to mention is in the work plan, leases. We still have it targeted for the last half of this year. And I just want to mention with respect to that is on the IASplus.com website, so the Deloitte's website, where we house our publications, there is a project insights that was issued March 3rd on the leasing project that is a fairly comprehensive summary of all the tentative decisions that have been reached to date. So if you're following that project, you may want to have a look at that. It's, like I said, quite comprehensive. It's about 18 pages long. So for your reading pleasure. And I think with that, John, I'm going to turn it back to you.
Thank you very much, Carrie. There was lots of stuff in there, too. IFRS 9, if you just the transition provisions are challenging, but that's life. The new Deloitte IGAAP 2015 manual is now available. This publication serves as an authoritative and practical reference guide for entities reporting under IFRS and for those considering whether to move to IFRS in the near future. For more information, please visit our website. The address is listed on your screen, or contact your local Deloitte representative. To purchase a hard copy of our newly released electronic version, or our newly released electronic version, visit the website highlighted at the bottom of your screen. We appreciate your feedback, so you should expect to see a pop-up survey appear on your screen shortly, which I'd kindly ask you to fill out for our development of future webcasts. We take these surveys very seriously, so please continue to send us your suggestions and feel free to also let us know what we're doing well so we can keep it up. Because of time restraints, we won't be able to get to virtually all of your questions today, so I'd recommend that you discuss your questions with your Deloitte partner or Deloitte contact so that they can help you resolve any questions or concerns that you might have. And I guess we'll try to fit in one question here for Maryse. Have the boards communicated the process they'll follow and the timing of future changes to the revenue standards?
Good question, John. So high level, what I can say is the FASB will be issuing proposed accounting standard updates based on decisions reached at their February and March meetings. And from the IASB's perspective, they've indicated that they wanted to incorporate their tentative decisions into an exposure draft of proposed clarifications to IFRS 15 that it decided to develop back at their February meeting. So the IASB expects to approve the clarifications to be included in that ED at its meeting in June or July of 2015.
Okay, thanks, Maryse. I understand that from several of our viewers that the sound had cut out partway through the webcast, and we do apologize for that. I'd like to thank our speakers, Anne Lamb, Maryse Vendette, and Carrie Daniluk. Also thanks to our behind-the-scenes team, Nura Taif, Elise Beckles, and Kieran Cooler. We hope you found this webcast helpful and informative. If you'd like additional information, please visit our website at www.deloitte.ca. And to all of you viewing our webcast today, thank you for joining us. This concludes our webcast, bringing clarity to an IFRS world, IFRS Quarterly Technical Update.